This week, we're talking staking cryptocurrency in Ireland.
That being said, a lot of what we'll discuss will be relevant for UK and European investors too.
At the time of recording, Irish tax authorities, and most European tax authorities for that matter, have said that there are no specific tax regulations for cryptocurrency assets. When we contacted Irish Revenue to ask specifically about the taxes that come with staking cryptocurrency, this was the response we received. Dear Stephen, apologies for the delayed response. Please note there are no special tax rules in place for cryptocurrencies. Wait, no special tax rules in place for cryptocurrencies.
Tax-free
12 seconds later.
No. Sadly, this does not mean no taxes on your cryptocurrency. It simply means that the current tax regulations, i.e. in Ireland or wherever you're watching this video, probably still apply.
So in terms of specifically talking about staking returns for Irish crypto investors, Revenue has deemed this as income, and you'll therefore be charged at your marginal tax rate as opposed to your capital gains tax rate. But more on this later.
Remember though, the crypto industry is nascent and it's growing very rapidly. So what is true right now, especially when it comes to taxes, might not be true by the time you watch this video, so we will try and keep you updated as best we can. I'm Steve.
I'm Cian.
And this is the Learnings Report, a show where we make investing accessible and understandable for everyone.
So there are a lot of conversations in the US currently on crypto taxes and staking, and when and where they should be taxed. Is it when you receive the tokens as a reward? Is it when you sell the rewards you receive? Or is it both? Discussions in the world are currently ongoing. We're going to give you an overview of where things are currently at.
So if you're already familiar with how staking cryptocurrency works and you want to jump straight to the tax stuff, use the timestamps that we've left below or in the description to jump straight to the section that you're interested in.
Or if you're new to staking or simply want a refresher, stick around for the whole video.
As Aristotle once said, the key to happiness is lots of likes and YouTube subscribers, so make sure to hit smash that like button if you find this video helpful. Okay, on with the video. So for those watching who aren't already familiar with staking, staking is an activity where a user locks or holds their funds in a cryptocurrency wallet to participate in maintaining the operations of a proof of stake based blockchain system, earning rewards in the process. And in simpler terms, it's simply your crypto holdings earning more crypto. The higher amounts of crypto assets that you stake, the more rewards that you earn. So essentially, by staking your coins, you are actively participating in validating transactions on the blockchain. If you plan to hodl your crypto assets for a long period of time, there's no reason why you wouldn't want to use staking to generate some passive income on those holdings. That being said, staking doesn't come without risks, so it is important to keep these in mind, but we'll discuss a few of those later on in the video.
So, how can you stake your cryptocurrency? There are a number of ways to stake your crypto, but the easiest way is often to go through the exchange that you generally trade with. For example, Binance and Coinbase. Binance has a ton of staking options, but Coinbase, at the time of recording, is a little bit more limited. In this video, we're just going to be looking at Binance. If you don't already have a Binance account, we have a referral link which we've left in the description, and this will give you 20% off all trading fees. You of course don't have to use this link, but we'd appreciate if you did. The caveat here is that staking on an exchange is called centralized staking. This means that they have control of your funds throughout the process. Decentralized staking, or DeFi staking, uses platforms like Compound or Aave and gives you a bit more control, but for a beginner investor it can be quite confusing. We'll touch on DeFi staking in this video, but if you want us to go into more detail, please let us know in the comments below. So why stake on an exchange rather than DeFi staking? Staking crypto on exchange offers the convenience of pooling investors' funds together, which allows you access to staking pools. So in essence, this means that you don't have to hit the minimum deposit that you usually would if you were staking on your own. For example, if you wanted to set up your own validator for Ethereum staking, you would need a minimum of 32 Ether, which at the time of recording is around $64,000.
Okay, so with all that in mind, let's have a look at Binance and how you can stake your crypto holdings using Binance. When it comes to staking on Binance, you have two primary options: locked staking and DeFi staking. So once you've set up your Binance account and you've logged in, you can come up to the top bar here, click Finance and click Binance Earn. The first thing that'll pop up is they'll give you an overall summary of kind of their most common products at the top. But if you skip down for now and come down to locked staking, that's what we're going to be looking at here. There are a couple of other options here that you can look at, such as savings, Ethereum 2.0 staking and launch bill. But for the sake of this video, we're going to be focusing on locked staking. So the first thing you'll see on the locked staking page is a list of the tokens on the left hand side, followed by their estimated APY or annual percentage yield, and then the duration of the days that you need to lock your crypto for in order to earn the returns. Generally speaking, it can range from 15, 30, 60, and 90-day options. On some platforms, you can see some as low as 7 days. The great thing about locked staking on Binance is that the minimum locked amount, i.e. the minimum amount you need to stake the crypto on the platform, is usually quite low and means that it's very accessible to all investors. You can simply browse through the list yourself, or you can come up here and search for a token of your choice and see if it's available. Not all tokens are going to be available in locked staking, so have a browse through and decide which ones you want to use, and sometimes it's simply easier to look at the whole list and click display available only. It's important to note that the duration isn't always available that you're looking for. Some of the longer days, such as the 90-day ones, which offer the highest APY, might not be available because they've already been oversubscribed. So you can see here for Clay, 90 days isn't available, KSM, 30 days is only available. So again, you're going to have to do your own navigation through these and decide what's most suitable for you. So think of locked staking somewhat like a fixed term deposit account. By locking up your crypto funds, you will earn a percentage reward for doing so. And this reward is usually paid in the same token that you've staked on the exchange. When deciding between staking for 30, 60 or 90 days, if you don't plan to use those coins for anything else, for example doing any trading, then there's no reason why you wouldn't want to get the highest APY and lock them up for the full 90 days. The main opportunity cost of locking it up for 90 days is of course that you won't have access to these funds during the staking period. That being said, there is one small caveat to that, because when you do stake with Binance, you are actually able to take funds from a locked staking pool and withdraw those, but if you do so before the staking period expires, you will have to forfeit any interest gained during that period. Remember, the APY percentage is an estimated annual yield. In order to estimate your total return, you can take your stake, multiply it by the APY percentage rate, and then divide that number by 12 to see what you might approximately earn on a monthly basis. If you have a 90-day lockup period, i.e. 3 months approximately, you can then multiply that amount by 3 to establish roughly what you might expect to make during the 3 months that your funds are staked. It's also important to remember that the APYs are dynamic and that they may fluctuate during this time, so the percentage that you see at the beginning when you first stake your funds might not be the exact same figure throughout. But of course, when you compare that to the measly returns that you'll get in a standard savings account, they're not really comparable. Another important thing to note is don't get too focused on very high APY returns. 1, because they fluctuate, and 2, you will earn the APY in the token that you've staked. So if it's a shit coin to begin with, you don't want to earn more of that coin unless you value it. So again, keep that in mind. Okay, so that's a brief intro to locked staking on Binance, but what about DeFi staking on Binance?
But hold on, did we say DeFi staking meant not using a centralized exchange?
We did. But Binance does offer a convenient workaround for retail crypto investors. But before we get into Binance and DeFi staking, let's quickly touch on what DeFi actually is. The term DeFi stands for decentralized finance. DeFi provides retail investors like you and I decentralized financial products using smart contracts on a blockchain. Imagine it loosely like a bank, but where there's no one in charge of the bank because everyone is kind of in charge of the bank. All that means is there's not one central authority, i.e. there's no real middleman. Everyone is in charge of the protocol. As mentioned earlier, staking on a DeFi platform can be a little bit more confusing and intimidating for a beginner investor, and this is where Binance steps in as a proxy, whereas it can be a workaround, i.e. it holds your funds and uses them on DeFi platforms on your behalf. It is important to note, however, that using DeFi staking through the Binance platform still comes with risks, even though you are doing it on a centralized exchange. Binance themselves do flag that they are not directly responsible for your funds if you are using DeFi staking. That is because all they do is facilitate DeFi staking through their platform, so they're not actually technically responsible for those funds. That being said, Binance do say that Binance selects only the best DeFi projects in the industry and monitors the DeFi system in real time while it's running in order to reduce the risks associated with such projects. I'm personally quite happy to use Binance for DeFi staking, but of course I'm also aware that there are risks that I'm running by doing so, and again, as long as you are comfortable with that risk, you shouldn't have any problems. To navigate to DeFi staking, simply click this tab here, and you'll see the options that Binance give for DeFi staking using their platform. The perks of DeFi staking is really the flexible lock system, which means that you can withdraw your funds at any time, and all you do is forfeit the interest rate for that day. Every interest that you've generated up until that point is yours to keep. Generally speaking, you'll also get a competitive APY relative to the lock staking, and of course, whereas you might get this rate through lock staking, you would have to lock your funds for a certain amount of time, whereas with DeFi staking, you don't necessarily need to.
So what are the main risks with staking? Most of the high-level risks, such as validator risks or slashing risks, are less pronounced when using a platform like Binance, as they are in control of the whole process. However, this is a risk in of itself, as you are not in full control of your wallet keys. There are a couple of risks when staking on Binance, primarily market risk and lockup period. With market risk, for example, if you're staking with a 15% APY, but your coin reduces in value by 50%, overall you're going to lose money. With lockup periods, generally you commit your coin and stake it for a certain period of time. During the lockup period, you won't have access to your coin, so if the price dramatically fluctuates, you won't be able to access it to sell it. This is less of an issue when staking on a platform like Binance, as you are actually able to access your coin during the lockup period. However, you will forfeit the interest that you have earned during that period. One final note, when people are talking about the risks of staking, they're generally referring to DeFi staking. As mentioned before, this generally carries more risk than staking on an exchange, as you are in full control of the process. That being said, if you spend the time to learn how to stake on DeFi, you may be able to earn larger APY returns. But we'll save that for another video.
And the next big question, what taxes do you need to pay when staking cryptocurrency? So before we go into any details specifically, let's just do a quick overview of the most common crypto tax questions that we get all the time. Question number 1. If you keep your crypto funds on the exchange or in your wallet, are you exempt from tax? In short, no. As soon as you make a trade, you are liable for that tax. Question number 2. Is swapping a crypto from one to another exempt from taxation? Again, no. If you swap Bitcoin for Ethereum, you are still liable for any gain that is made between the two values when you trade it. In most countries, that action of swapping one crypto for another is seen as a sale in of itself and thus is taxable. And question number 3, can you avoid paying tax on your cryptocurrency gains by moving to another country? In short, the answer is maybe, but it really depends on what country you're from, the rules and regulations within that country, and of course you may have to go for a longer period of time than simply a holiday, sell your crypto and come home. So again, make sure to do your research before even considering doing that. Anyway, with those out of the way, back to staking taxes. From our research, and at the time of recording, most countries that we've seen seem to classify staking rewards as income from a taxation standpoint. This means that any coins or rewards that you receive as part of staking should be taxed at the time of receipt, i.e. when they go into your cryptocurrency wallet. The fair market value of the coins on the day that you receive them should be used as a cost basis for your taxation calculations. The issue, of course, is that with staking, rewards are often paid on a daily basis, which means that you are going to have a lot of calculations to figure out. There's nothing stopping you doing this on an Excel sheet or a Google spreadsheet, but of course, the more transactions you have, the more complicated this process is going to be. That's why you're going to see a lot of crypto tax services popping up, and we're going to mention a few now. We haven't used any of these tax services extensively ourselves, but a couple of the ones that you might want to check out are Coinly, cointracking.info, and CoinPanda. So I actually created a Coinly account just this week, and from my basic research that I've done, Coinly seems like a decent option, primarily because they offer 10,000 free transactions on a free account, whereas some of the other services I've looked at offer a lot less, and you'll have to bump up to a paid plan soon thereafter. So although I'm not a big crypto trader personally, I do make a number of transactions per month, but you probably will be surprised once you link up your Coinly account to your Binance exchange, your Coinbase account, etc., and see how many transactions you've actually made. So again, just keep this in mind when you are trialing these services, because it'll decide what plan you want to go for. If doing a video on crypto tax services is something you'd be interested in, do let us know in the comments below and we'll be sure to add it to the list. So we're going to borrow an example from coinpanda.io, one of the cryptocurrency tax services we mentioned, to illustrate what sort of taxes you might end up paying when doing cryptocurrency staking. For the case of this example, they've simplified it down to a monthly basis to show the amount of coins received from staking and then the price on average from that month. However, when it comes to doing your own taxes, you will have to do it on a daily basis because of course the price will fluctuate on a daily basis, and in order to calculate what you owe in terms of the reward that's paid out, you will need to take the price on that given day and calculate the tax due. So that's where these crypto tax services can come into play because of the sheer number of transactions and calculations that you're going to need to do. But again, to return to the example, what they've done here is that you can see on the 1st of May, the 1st of June, 1st of July, and 1st of August, they've calculated, okay, how much Tezos was received, what was the average price of Tezos during that period, and then they've calculated the taxable income based on that price. So then when you come down here, you can see that they simply added up the 4 months in terms of the taxable income, and you've got your total of 557 and 6 cents. So building on this example from an Irish standpoint, in Ireland, the marginal tax rate that you pay on income is either 20% or 40%. So if you were in the higher income tax bracket and you earn this $500 from staking, you will add this to your annual income and pay the 40% tax due. When it comes to filing income outside of your PAYE job in Ireland, you will need to file either one of 2 forms based on your certain scenario. If your total income is less than €5,000 from staking and other income sources outside of your PAYE job, you'll need to file what is called Form 12. You can find this through My Revenue in My Account. If the income that you generate from staking or side hustles or online sales is greater than €5,000, you will need to register as a self-assessed individual by registering for Ross on My Revenue, and you'll also need to file what is called Form 11 at the end of the year. We'll be releasing videos on how to fill out both of those forms in the very near future, so stay tuned. It's really important to remember that with staking, you get rewards and they're considered income. So this is separate from, say, the gains that you make in your shares or your general crypto investing that are subject to capital gains tax. And remember, because staking is considered as income as opposed to gain on an asset, you will not be able to use your capital gains tax exemption of €1,270 to offset the taxes that you owe on these staking returns. But we're not finished yet. So you've received your staking rewards, you've got more coins of the token that you were staking, life is good. But now of course you want to use these tokens, so you either want to sell them to fiat currency or to exchange them to something else. So then you decide to go ahead and sell these earning rewards to generate a gain. You are now subject to capital gains tax on any gains that are made from that sale. So technically what's happening is when you get the rewards, you are charged at an income tax rate. But then of course you own these rewards, and if you go ahead and decide to sell them, say a year or 2 down the line, and then you make a profit from selling them, then you are due capital gains tax on any profits made. Sound a bit unfair? We agree, and so does a lot of the crypto community. At the time of recording, there are a number of ongoing cases in the US where people are trying to appeal what sort of taxes are paid on staking crypto. People are arguing that it's not fair that you are paying income tax when you receive the tokens as a reward and then charged again when you go to sell them at a capital gains tax rate. Essentially, the argument is trying to say that you should only be charged tax when you actually sell the rewards that you earn, as opposed to when you receive them and when you sell them. If you've done any research into cryptocurrency staking taxes, you'll have likely come across the example of how a baker bakes a cake and the baker isn't charged for income tax when the cake is created. She is only charged when that cake is sold.
Sweet, delicious, taxable cake.
The correlation that has been made here when staking cryptocurrency is that when you are getting staking rewards, you are essentially creating property and thus shouldn't be due income tax. You should only be due capital gains tax when you go ahead and sell that property. If you're interested in following along how these cases are proceeding, we'll leave links in the description below which will track what's happening. So an overall summary, unfortunately at the time of recording, cryptocurrency staking is seen as income in most tax jurisdictions and thus is due for income tax upon receival. In addition, if down the road you then decide to sell the rewards that you received from cryptocurrency staking, you will then be charged again for capital gains tax. Of course, this is far from ideal and hopefully it changes, but again, as mentioned, these cases are ongoing, so we're going to have to see what happens.
Governments are still playing catch up in the crypto space and discussions are ongoing.
We'd love to hear what you think about crypto staking and the tax implications, especially in the country that you're watching from.
We'll be keeping up to date with all things happening in Ireland, so be sure to subscribe to stay up to date.
And in the words of Aristotle, make sure to smash that like button, and otherwise, see you in the next one.
And we could do the SpongeBob thing 2 minutes later or something like that, and it's like